Hello guys and welcome back to another video. In this video I'll be going over everything relating to fair value gaps. I will cover a whole host of terms that you must know, such as consequent encroachment, what is a BISI, what is a SIBI, what is an inversion fair value gap, what is a volume imbalance, and what is a liquidity void. So make sure you have a notepad and pen ready because there's going to be a lot of detail and information in this video. So without further ado, let's get straight into it. So first off, let's define what a fair value gap is. So fair value gap is simply a free candle pattern. So here on the left hand side, we have candle number 1, candle number 2, and candle number 3. A fair value gap is where the low of candle number 1 does not overlap with the high of candle number 3. You can see a separation between the wicks, and this is your fair value gap. Now, a lot of times, a fair value gap is also referred to as an imbalance. Similarly, if we take a look at the right hand side over here, we can see the high of candle number 1 does not overlap with the low of candle number 3. We have a separation in the wicks right here. This is our bullish fair value gap, and I've shaded it over here as well for you guys. Now, before we get into examples on how to implement fair value gaps, let's quickly go over what is a SIBI and a BISI. A SIBI is simply defined as a sell side imbalance, buy side inefficiency. That is what it stands for. So over here, we have sell side delivery of price right here, creating an imbalance right here, or a fair value gap. But we are inefficient in buy side delivery, right? That's why it's called a sell side imbalance, buy side inefficiency. Similarly, on the right hand side here, we have buy side delivery on the upside. So we call it a buy side imbalance or fair value gap. And then we are inefficient in sell side delivery. Okay, so that is the difference between a SIBI and a BISI. All right, guys, let's take a look at how we can use a bullish fair value gap to go long. So right here, we can see that price has taken out this swing low right here for sell side liquidity before having displacement to the upside with a market structure shift above this swing high right here. And we can see it left behind a fair value gap right there. So we can draw that out as shown right here. And then we can look to enter off of that fair value gap. So if I play price out, you would place your entry right there and look to target some form of liquidity. So let's play price out. Okay, we enter right there and you'll be looking to target this old high right here. So if we play price out, we entered right here. We respect the fair value gap. And we take it out right there and move significantly higher above that level. So notice how we are respecting this fair value gap right here before having that movement to the upside. Again, guys, same thing. Over here, I've identified a nice pool of sell side liquidity in the form of these relatively equal lows right here. We've had a nice displacement and market structure shift right here, below this swing low right here. We have a nice bearish fair value gap right here, and we can look to enter off of this fair value gap, looking to target this pool of sell side liquidity. So looking to enter off of this fair value gap right here, we would be looking at just above a 1 to 2 risk to reward. So if we play price out, you can see we respected the fair value gap nicely and we hit the relatively equal lows right here. And again, we have another fair value gap here. Notice how we respect it here and then continue down to the downside. So now the next thing we're going to be covering is what is consequent encroachment, or CE for short. So consequent encroachment of a fair value gap is simply 50% or the midpoint of a fair value gap. Here you can see this with this dotted line right here. So now with the consequent encroachment level, you might be wondering, how do we implement this into our trading? Well, simply if we are bearish and looking to go short, this 50% level allows me to have a judgment as to whether I am likely to be right or wrong. So once I have figured out I am bearish, I will look to enter inside of this fair value gap. And I would like to see price respect this 50% level. I don't mind the wicks going up into the upper half as long as the bodies are staying below consequent encroachment. So anywhere in the lower half of this bearish fair value gap right here, this would to me indicate that my trade idea is likely to be correct. If, however, I start to see this candle close above consequent encroachment, and especially if we start to close above the high of this fair value gap, this to me would be likely invalidating this fair value gap, and we are in for a potential reversal scenario or a retracement. Now the exact same thing would be said when I am bullish. I would look to be entering as we entered this fair value gap right here, and I would like to see 50% or consequent encroachment be respected. However, I would also like to see the bodies remain preferably outside of the fair value gap. It can also be inside, but main thing is it must be in the upper half of this fair value gap. If we then start to close below consequent encroachment, or especially if we close outside of this BISI, then to me this BISI will be invalidated and we are likely in for a retracement or a reversal. So if I see price respecting consequent encroachment, then my trade idea is likely to be right and we are likely to continue the move either to the downside or to the upside. So now let's go over how we can now use consequent encroachment. So over here I've identified my bearish fair value gap or SIBI, and I can then also mark out my premium discount from this high to this low. 50% is here. This fair value gap right here is in a premium, making it a valid fair value gap, and we'll be looking to enter off of this fair value gap right here. So now let's see how price reacts inside of this fair value gap. Does it respect the consequent encroachment level or does it not? Let's see. Okay, so we hit it there. Notice how the bodies are respecting the lower half of this fair value gap right here. We touch it with this wick right here, the consequent encroachment level, and we quickly reject it right there. Let's see how price reacts afterwards. And we absolutely melt down to the downside. Now notice here, we have a bearish fair value gap right here. However, if I draw from this low to this high right here, you can clearly see the bodies are closing right above consequent encroachment. This is likely invalidating this fair value gap right here, and we would not be looking to take a short from this. And also it's very obvious to see that we are clearly in a discount in this range, so you would not be even considering this in the first place. There was no closing in the upper half of this fair value gap, making this consequent encroachment level a nice indication on whether your trade idea is likely to be right or wrong. Again guys, let's go over now a bullish example. So right here we have this nice pool of sell side liquidity right here with these two relatively equal lows. We trade below it right here before getting some displacement to the upside, and this is our bullish fair value gap or BISI. So I've marked out the 50% or consequent encroachment level right there. So now let's play price out and see how we can use this. Okay, so we touched it once here, and notice how the bodies are respecting the upper half. The wicks might go below it, but we quickly reject and close right in the upper half. Playing price out, touched it again, move to the upside. Okay, so we're not moving in this lower half. We're not closing down here. Notice that, guys, okay? Okay, so here, bodies are respecting this level. Notice how it's very accurate. We go down right here to the extreme of this lower half, but quickly reject and get nice displacement to the upside. So now if you miss this entry right here with this large fair value gap, you could look at this right here. We get displacement right here with a market structure shift above this swing high right here, and this is your fair value gap slash BISI. So you could have entered right here. Okay, so this could be a secondary entry you could have considered, and if we play price out, you can see we move to the upside very nicely. So notice how this is giving us an indication on whether our trade idea or directional bias is likely to be right. So we can see we took out a pool of sell side liquidity right here. We get displacement. We want to see how we react with this fair value gap right here, and you can see how we are clearly respecting consequent encroachment, indicating that we are bullish. And you can also get secondary entries once we get some form of displacement and price presenting a nice fair value gap for us. And again guys, notice how we are entering in a discount from this high to this low right there. We are below 50%. This would be a very high probability entry that you could consider. Now let's go over what is an inversion fair value gap, or IFVG for short. So with inversion fair value gaps, once we've already identified either a SIBI or BISI, and we see price now close above the SIBI or BISI, like shown here for a bullish example, we can see that this SIBI has been disrespected. We closed above it, and this can now be treated as an inversion now. So we can be looking for retest or support at this specific price level to see a continuation to the upside. The exact same thing would be said for a bearish scenario, whereby we see price close below this previous BISI right here, invalidating this BISI, and we can be looking for retests and retrading into this specific BISI, old BISI right here, for a continuation to the downside. So essentially, we are now just inverting this and treating this as an inversion fair value gap, where it was previously a normal fair value gap. So now let's go over some chart examples to show you this in more detail. Now guys, before we get right back into the video, I really really quickly want to talk about my private mentorship. Now guys, if you give me 30 seconds, I promise you, you will change the whole trajectory of your trading career. With this mentorship, guys, I will teach you the exact model that I have taught to my members, which has helped them to scale to over 7 figures plus in funding from prop firms, and they are consistently making $10,000 a month from trading, and they are quitting their jobs for good. I have literal students that are making yearly and monthly salaries in a day. Okay, you guys might think this is a lie, but trust me guys, when you know how to trade, this is completely possible and is a reality that most people are living. Now you'll have a whole host of benefits as listed here. You can have a read for it yourself. This is a lifetime access for a one-time payment only. I have now put the price down by £100. It was previously $249.99, but you will now be getting it for a limited time only for $149.99. okay, make the most of this offer guys. Learn the skill set properly. I'm willing to teach that to you guys here for a specific price. I will teach you the exact blueprint to help you get funded and quit your job guys, and live a life you've always wanted to live. Stop wasting your money on prop firms blowing challenges when you have not even learned the skill set in the first place. Okay, so start your journey to profitability today. Click the first link in the description and be a part of the best ICT community in the world. So with that being said, let's get straight back into the video. Okay guys, let's see how we can implement an inversion fair value gap for our potential entry. So clearly in this chart right here on the 15-minute time frame, we can see price has taken out these relatively equal lows right here before us getting displacement to the upside. Over here, this previous bearish fair value gap or SIBI, we violate that on this candlestick right here, closing above it. This will invalidate this previous fair value gap right here. So now we can use this now as an inversion fair value gap to go long and see a continuation move to the upside. So playing price out, let's see how we react in this area right here. Okay, if I stop it right here, we've hit it right there and had the immediate reaction to the upside. Now let's see how we continue out. Okay, and playing price out, we can see we continue to the upside. And notice how the bodies are in the upper half and we are respecting the consequent encroachment level. All right guys, now we're on a 5-minute chart. We've taken out this high right here for buy side liquidity, and we have this BISI right here. So let's see how price reacts off of this level right here. Okay, we disrespect that level right here, closing below it. We create another fair value gap right here, this time a SIBI. So you have two levels right here, an inversion fair value gap with this orange one right here, and a normal one in this blue one right here. But to make it less confusing, let's just go over the inversion fair value gap example. However, both could be valid. Okay, so here we have our inversion fair value gap. You'd be looking to enter at the low of that inversion fair value gap with stop loss at the swing high, and then looking to target some pool of liquidity. So if we look back, you can target this low right here or this low right here for sell side liquidity for a nice 1 to 2.5 risk to reward. So let's play price out. We get filled right there. And you can see we hit that low right here, hitting take profit. Notice how the bodies are in the lower half. Okay, so the bodies are telling us the story of price action. The wicks are doing the damage by coloring outside of the box or the inversion fair value gap, but the bodies are telling us the real narrative of price action. Now, the final two terms I want to introduce you guys to is volume imbalance and liquidity void. Let's start off by explaining what a volume imbalance is. A volume imbalance is simply where we have a gap between the bodies. We have a gap between the close of this candlestick right here and a gap between the open of this candlestick right here. So whilst we do have trading here, the wicks are overlapping, the bodies are not. And this is how we define our volume imbalance. Now, a liquidity void is similar. We have a gap here. However, there is no trading between the high of this candlestick right here and the low of this candlestick right here. So this is what we refer to as a liquidity void. We had an absence of trading between these two candles right here. All right, guys, so now let's go over an example of how you could use a volume imbalance. So over here, I've identified my volume imbalance. We can see there's been overlap of trading between this candlestick right here and this one right here. However, the bodies, there is a clear gap between them. So this is our volume imbalance. And I've also identified an inversion fair value gap with this SIBI right here getting violated on this candlestick right here as we closed above it. So now let's see how price reacts within these two areas, especially the volume imbalance. So now playing price out. Okay, we hit it here. And notice how we are respecting the 50% of this inversion fair value gap right here. If I show you right now, the bodies are in the upper half. And let's continue to play price out. Okay, look at that reaction on these two candlesticks right here. Color outside of the volume imbalance, but look at the bodies. Okay, especially here, we are now consolidating right here in this 50% mark. We are not trading and closing at the lower half. And you can see a lovely reaction to the upside right here, continuing to play price out. You can see we move nicely away from those two areas. Okay, so this is how it would look like. All right, guys, and finally, let's go over an example of a liquidity void. So right here, we can clearly see a liquidity void where from this candlestick's low to this candlestick's opening price, we have a clear separation right there. So this is our liquidity void where no trading occurred. Now, these liquidity voids typically occur during session opens, right? So for example, Monday's trading into Tuesday's trading, it could be a new week, for example. So this was Friday's closing price right here. And then on Sunday, we opened up here. So there was an absence of trading as shown here. So now going into the rest of the week, we can then use this area, for example, for a targeting purpose. So we can clearly see right here, we are now in a discount relative to this high and this low. So if we were looking to go long down here, we could look to target this liquidity void right there. We could look to target the low, the consequent encroachment, and then see if we could potentially look to close the entire liquidity void. So now playing price out. Okay, we hit it right there, respecting consequent encroachment. We hit it again. Notice how we're very sensitive at that price point right here. Okay, so we hit it again here and here, have a nice rejection to the downside, and we consolidate throughout this entire liquidity void. So this is just an example of how you could use a liquidity void. You could also use it for entries or targeting purposes. So we've now reached the end of the video, guys. If you found this video helpful, please let me know in the comments below, and also by dropping a like on this video. Make sure you subscribe for more videos like this, and until I see you next time, peace.